Welcome everybody to 15 Minutes of Finance, where in the next 15 minutes, I'm going to get you excited about investing. Let's do it. Okay, guys, we have a lot going on this week. And by a lot, I mean one really important piece of information, and it's our term of the day, and it's going to be PCE. So this is personal consumption expenditure. This is a very important piece of data that the Fed uses to decide, to make all their decisions. I don't quite know why this isn't more publicly available information. It's not, retail investors don't know about PCE data. I don't really know why. You do know, however, about CPI data, right? The Consumer Price Index. That is effectively what people think of when they think of inflation data. But the Fed uses PCE data, right? So the personal consumption expenditure data, it's way more broad than the CPI, and it allows them to get a better depth and breadth of the information. So PCI takes, I think, a third of the information is housing, whereas PCE is everything, right? It's healthcare, food, transportation, and also includes housing, but it's just a way, way broader aspect that the Fed uses to make their decisions. Not entirely sure why CPI is the big one that everybody likes to talk about. Mainly because it's probably been around longer is the number one thing I can think of. But that's important because Friday we get those PCE numbers, and that's going to be a big decision for any other future rate cuts that we get. Okay, all right, let's talk about the news. Okay, it's all-time high seasons right now. Seems like every day we're getting major volatility and then all-time highs. So let's cover this news here, guys. Okay, U.S. stock indexes were mixed in morning trading, with the benchmark S&P 500 and tech-heavy NASDAQ edging higher after ending at record highs on Friday, but the blue-chip Dow Jones Industrial Average slipping from its all-time high closing. After the Federal Reserve last week elected to cut interest rates for the first time, market watchers will be eager for clues about whether more cuts are in store in the coming months. Several data points slated for this week should be offering insight, including Friday's scheduled release of the Fed's preferred inflation measure, the Personal Consumption Expenditures Index. Waiting on markets to begin the week is a potential U.S. government shutdown, after dueling bills to keep federal operations running were shot down in the Senate on Friday. Safe haven gold futures were up 1.3% to trade at an all-time high around $37.55, while riskier assets like cryptocurrencies sold off. Bitcoin was down nearly 2% at around 113,500, while Ether was 6% lower at 4,200. Love that they're finally including Ether in this data information that we're getting. XRP might be next. Okay, Tesla and Apple were two of the best performing stocks in the S&P 500 Monday morning, up roughly 4% and 3% respectively. If you guys listened last week, we talked about Tesla. Actually, listen last episode, which would have been Saturday, respectively, after each received a notable price target hike. Piper Sandler raised its price target on Tesla stock to $500 from $400, while Wedbush lifted its targets for Apple shares to $310 from $270. Oracle stock rose 2.5% after the company unexpectedly said CEO Safra Catz would be shifting to an executive vice chair role, and the executive Clay Magaric and Mike Cecilia were being promoted to run the company. T-Mobile US, ticker TMUS, shares edged up after wireless company said CEO Mike Severett would be replaced by COO Srini Gopalan on November 1st. And Moslin Coors Beverage, ticker TAP, stock slipped 1.5% after it announced strategy chief Raul Gaul, that's can't be his name, Raul Goyal, would succeed Gavin Hattersley as CEO on October 1st. Pfizer stock advanced 2.5% on news it was acquiring weight loss drug developer Metsera, ticker MTSR, for up to $7.3 billion. And Metzer shares soared roughly 60%. Good for Metzer owners. I love that. Kenvue, ticker KVUE, shares dropped 7% to lead the S&P 500 decliners on a report that Trump administration was set to link use of Tylenol by pregnant women to autism. The 10-year Treasury yield, which affects borrowing costs on a variety of consumer and commercial loans, was at 4.14%, up from 4.13% at Friday's close. West Texas Intermediate Futures, the U.S. crude oil benchmark, were down 0.7% at 62.25 a barrel. The U.S. dollar index, which tracks the value of greenback against a basket of foreign currencies, hit its lowest levels since early 2022 Wednesday, slipped 0.1% to 97.54. Okay, that's the news for today. I don't really have much to say about it. We have another volatile day, I assume. Let me look directly at what the market is right now. Let's take a look. It's 6,677 spot 32, so it's just up about 0.2%. I expect there to be volatility today. Usually Mondays are just tough, especially with big data at the end of the week. It's usually when rumors start to tie in and different opinions start to falter. So what do we know about buying the news, buying the rumor, selling the news? Is probably a good idea if you want to be a day trader. Okay, guys, I wanted to talk today about us going from a producing economy, a production economy, a consumption economy to a production economy. This is massive, very important for everybody in the United States, pretty much for anybody who invests in the United States. So it definitely has global impact. But as retail investors, as people interested in the economy or the market, the stock market is a leading indicator, meaning whatever the stock market is sentiment-wise, how it's doing, what people think about the stock market, that is a leading indicator, aka a forward-looking sign of the economy. So it's not the only one, but it is one of them. So when the stock market does really well, there is sentiment that the economy itself, GDP expansion and whatnot, is increasing. Okay, it's not the only leading indicator, but it is one of the ones that gives you a good idea of what is happening in the future. Okay, because stock market, it's never priced for what something is worth right now. It's always pricing things for what they're worth many years from now, many months from now, in the future. So right now we're like a 70% of our GDP, of the US's GDP, 70% of it is consumption. Okay, it means we're buying retail, food, banks. I don't even know what else. Pretty much anything that we're doing to increase our GDP comes from us consuming and purchasing things. Okay, as we shift to a production economy, which is one of the biggest initiatives by this administration, we're going to be way more valued on what we produce and what we export. Okay, this is very, very important because for the stocks, for the stock market, for investing in general, it is a cyclical change. Okay, you hear cyclical cycles all the time. There's many throughout the year, but this is a major shift in the foundational way that our country makes money. Okay, so we are going from right now we're at about 70%. 70% of our GDP comes from what we consume and not from what we produce. Okay, so that is majorly shifting. Okay, the administration is dumping billions of dollars into rare earth metal funds. They're wanting to create this massive crypto backing, which is going to have, once that happens, there's going to be an infrastructure change to the way crypto is mined, stored, kept, and that takes a massive amount of energy, a massive amount of infrastructure. Chips, right? He want all these companies, all the news you guys have heard about for the last couple of months, especially since tariff talk, April 1st. You have heard him say, oh, we just made a deal with Apple. They're building a $500 billion investment here in the US. Oh, we just made a deal with NVIDIA. They're going to build chips here for, $300 billion. Whatever the amount was, I'm remembering perfectly, but those kind of changes, those kind of investments, that is a production change, right? They're not making things in China. They're not making things in India. Well, they are, but everything is shifting to making them here. And once that happens, that is going to change the stock market. It's going to change what stocks really do well. Or in this case, chip makers is the big one I want to talk about. Semiconductors, chips, the rare earth metal that is needed for all of those things. Anything tech-wise, guys, you need rare earth metals. You need copper. You need silver. You need lithium. You need cement. You need chemicals that we can't pronounce or name. Those types of industries they're going to benefit the most from this change to a production economy. And it's important because I want your guys' portfolio to be prepared for that. Okay, and I'm not talking about next week, next month. This is going to be a year-long shift, and I would bet by 2030 it flips. Okay, so now we are a 70% production economy, where 70% of our GDP comes from production, and then 30% comes from consumption. And what that does for everybody is it allows us to get prepared. Okay, that's what I want. I want you guys to be prepared. I'm not saying dump all your money into NVIDIA or Palantir or any of these big, or Tesla, any of these big robotic chip maker technology companies. I'm saying that we can start shifting our mind there, our way there. Okay. If you're able to allocate your portfolio correctly to the economic shifts, okay, I'm not saying time the market, but slowly over time start making these changes, you will benefit. Okay. Even if there's a market dip, even if there's a market change, a stock market crash or a recession, you can think about this change in your strategy and these sector, investing in these different sectors as a massive, massive discount. If there is a recession, if there is drops in the market, you're getting great companies, things that a whole country is dependent upon. The S&P 500 alone is more than 45% of the entire globe's equity. Okay, think about that. Okay, when recessions happen in the S&P 500 in the economy, it's not entirely the economy, but it is a good representation of the US market. The rebound, I'm not allowed to use the word guarantee. I hate the rules that I'm kept to, but I do my best to try to keep to them. When that happens, though, it's in the whole world's interest for that to be at that bottom, whatever it is, 20, 30% drop for as little time as possible. Okay, it's in everybody's interest that comes back up to normal levels or even all-time highs. So what does that mean when that happens? That means that those are cheap, good prices for you to jump in. And if you are slowly moving your growth assets or even your utility assets, your bonds, if you're able to move your holdings into the infrastructure, the energy, the commodities, the semiconductor, if you're able to move into those sectors as we're changing to a production economy, your portfolio will thank you. Okay. Again, guys, I'm not allowed to provide financial advice unless it's directly to an individual. Obviously, you guys aren't individuals. You're a group. This is an audience here. So take this as education. Please go do your own research. And as always, invest early, invest often. We'll see you next week.